Good morning. I'm going to start right off the bat and I'm going to start sharing my screen with you. So, yesterday we were talking about credit and different types of credit. And this is where we left off. We left off with forms of credit: long term credit, a house or a car loan designed to last beyond 3 years, while short term credit is designed to last for less than 3 years. Service credit, it's not a loan, but it's credit because you're consuming the item, then you're paying for it after the fact. That's your electric bill, your gas bill, your cable bill. I would put my cell phone in there as well. So what we're going to do is we're going to take a look at the different types of credit and maybe provide some examples of long-term credit. So long-term credit generally requires a form of collateral. We know collateral is something that you put up. In other words, if you don't make the payment, if you default, that's what it's called when you don't pay back your loan. If you default, they can take this item from you. The most popular form, the one you guys are most familiar with, is something called a home mortgage. Mortgages generally last anywhere from 15 to 30 years. A lot of people start off with a 30-year loan. Sometimes if you do 15-year loan, it's fantastic. Now your payment's going to be higher, but what ends up happening is the overall payment, when it's all said and done, when you include the finance charge, is much less. Problem with younger people or anybody in general is that they might not be able to make that bigger payment. So here you receive the payment. I get mine in the mail every month, and it tells me exactly what I owe, which it doesn't change because I have a fixed amount. But here's what you need to know. Most of your payment in your first handful of years is applied towards the interest and a little bit towards the principal. So I had, and I'm not going to show it to you, but I've had something where I would show you how a mortgage works. And it went through month by month and how they split it up. It took 21 years before the majority, over 50% of my payment, went towards the principal. That's because banks make money off of loans. People have a tendency to keep a house for several years and they move on to maybe a bigger home and they move on to a bigger one yet. So banks want to make as much money as they possibly can at the very beginning. So if you get a 30-year mortgage and you want to make an extra payment, let's say you want to make an extra $300, and there's a memo line, you need to tell them you want to apply it to the principal. If you don't, they will split it. So that's a home mortgage. The other one's a car loan, 3 to 7 years, and it's a little more balanced in how they split up the money. Little bit more balanced that way. That primarily because it's a shorter loan. So there's something called a secured loan and an unsecured loan. Secured loans are car loans, are mortgages where there's collateral involved. An unsecured loan doesn't require collateral, primarily because there's not a lot of collateral within that loan. Sometimes they're called a signature loan. Okay, it's based upon your loan rate then, and everything else is based upon your credit rating, your references. Your references primarily relate to your employer and information they receive from your employer. Sometimes every now and then you might have somebody serve as a reference for you, kind of like you would for a job. But with these types of loans, and a lot of times student loans are this way, there's no collateral, that they can't take your degree away. So a lot of times this signature loan, for student loans, you need to get a co-signer. So we've co-signed for our kids, and primarily what that means is that they're using a little bit of our credit score, and we're saying we will support them, we will back them if they can't make the payment. So the difference between a secured and unsecured loan is secured loans typically do not require a co-signer, and there's collateral involved. Unsecured loans typically require a co-signer. There are some secured loans that will require a co-signer if your credit score is low enough. So let's take a look at short-term loans. So the most popular type of short-term loan out there is a credit card. Credit cards, MasterCard, Visa, they're issued by almost every bank. You could obtain a MasterCard or a Visa. You could get them through a lot of times they used to go on college campuses. They're banned now. And if you went to Ohio State, you could get an Ohio State MasterCard and have the Blocko on there or Brutus Buckeye or something like that. And these are what are called revolving accounts. They will give you a preset amount. And let's just say it's $1,000. So you could charge up to $1,000. And if you charge $100, you have $900 left the next month, etc. And the way they generally work is that they typically don't allow you to go above that amount unless the interest and stuff takes you above that amount. And they always give you a minimum payment, somewhere between 2 and 4%. Now, I talked to you yesterday about minimum payments. Minimum payments are not designed for you to pay it off in a timely fashion, nothing like that. They are designed to get as much money out of you as possible. So credit cards are revolving accounts. And if I had $1,000 limit and I borrow $100 and I paid it off, I have $1,000 again. It always goes to that $1,000. Now, as you get older and maybe you need more money, maybe you call a credit card company and ask to have your limit raised. If you're struggling and maybe you don't trust yourself, you could go to them and you could ask them to lower your minimum payment, or to lower your minimum amount that you could spend. So again, ignore that. I don't know why I have that in there. So sometimes I bet you heard of an American Express card or a Diners Club card. These are somewhat more of a travel card, entertainment type of card. Here's the biggest difference. MasterCard, again, is issued by so many different banks. American Express is primarily issued by the American Stock Exchange. But the biggest difference is that you have to make full payment every month. These aren't real popular cards. They used to be more so, but they're not so much anymore. The service fee. So every time you go to use a card, there's a 2%, 3% service fee. These may be 4 or 5%. Okay. There's no interest, but there's a membership fee to go along with this. I'm just sharing it with you. It's nothing that most of us have, but they're out there, just so you know. Okay, they're out there. One more slide, and there's the example. So we're going to take a look at store cards. Now, a lot of you are familiar with store cards, especially when you go to Kohl's. They always ask you, do you want to put it on your Kohl's card? And you say yes, no. Do you have a Kohl's card? Yes, no. If you don't have one, they always try to offer you one. So they're like a credit card, obviously, but with one restriction. They give you a credit limit, max that you could charge on your card. But obviously the catch with it is, with my Kohl's card, I can only use it at Kohl's. It's restricted to that. So why would you get this? Why would you get it? The APR might be slightly higher than a credit card, but what Kohl's does is they offer you discounts or other incentives. You heard of Kohl's Cash. If you use your Kohl's card at Kohl's, they will knock, I think it's 20% off your purchase. And some people are like, well, why would they do that? Why would they offer 20% off? Because they know the typical American doesn't pay their card off. And then that's where they hit you with the interest rates and they make up for it. Stuff like that. You could use your MasterCard, but you don't get 20% off. You don't get Kohl's Cash. So people like Kohl's Cash. Sometimes I mentioned yesterday, I have a Goodyear card. If I go to get tires, I typically go to Goodyear, and I think they have 6 months, same as cash. So if I could pay it off in 6 months, and my tires, let's say, cost $800. If I could pay $800 off in 6 months, it's like I gave them $800 that day. Again, they know the habits of people, and people have a tendency not to do that. Let me show you the last type of credit. I'm going to show you some examples. Kohl's, Best Buy, BP, a gas card, is something called a line of credit. So it's an equity line of credit. This is based upon equity that you have built up. It's a pre-approved amount, and it's typically for a set amount of time. Most of the time, you get an equity line against your home. So if you had your home for 5, 6, 7 years longer than that, you've built up some equity in the home, and you could borrow against that build-up amount. And like I said, it's pre-approved for a set amount of time. And we received an equity line when my daughter got married to kind of help pay for that marriage. We got an equity line. I think it was for 5 years, and we used it for her wedding. We never used it after that. When the 5 years was up, it kind of went away. And you pay for only what you use. I have no idea, to be fair, how much we paid for her wedding, but let's just say we paid $5,000, and let's say my equity line was $10,000. If I only borrow 5, I only pay 5,000. You actually we got a checkbook, and we wrote checks and went against that, and then you pay interest on it and everything else. But that's a line of credit. Sometimes some people like to keep them just in case of emergency, or if they want to do a big project on their home, they might go out and get an equity line of credit to put, I don't know, a small addition on their home, or to redo their kitchen, which could be costly. Instead of financing it through Lowe's or whatever, it's cheaper to do it this way because the interest rate is lower. So they might opt to do it like this. So those are really quickly, those are different types of credit you could obtain. We'll wrap this whole entire thing up tomorrow. We'll talk about the advantages and disadvantages of credit. We'll talk about how to establish, how to obtain a credit card, how to establish a little bit of your credit score, some things to take a look at. And for the most part, guys, we will be done. So I hope you have a great day, and I will see you on Wednesday. Take care.